Bitcoin drops to $112,656, a 17-day low. Panic selling erupts across social media. The crowd screams crash, and bubble burst. Fear reaches levels not seen since June. And then there's the data from Santiment that changes everything. Retail traders have done a complete 180, reports the blockchain analytics firm. The past 24 hours marked the most bearish sentiment seen on social media. Since Middle East war, fears triggered massive sell-offs. But here's the twist. In Bitcoin markets, when everyone panics, that's usually the perfect time to buy. In the next 4 minutes, you'll discover why extreme retail fear is a legendary buy signal, how smart money accumulates when crowds panic, and why this latest sentiment flip could mark the bottom of Bitcoin's correction. Welcome to the psychology of contrarian investing, where fortunes are made when others lose their nerve. The numbers tell the story of a market in full psychological retreat. Bitcoin's fear and greed index plummeted to 44 out of 100, officially entering fear territory for the first time since late June. Social media sentiment did a complete reversal in just 24 hours, transforming from cautious optimism to outright panic. Retail traders have done a complete 180 after Bitcoin failed to rally and dipped below 113,000, Santiment reported. The sentiment shift wasn't gradual, it was instant. One day traders were hopeful about new highs. The next, they were convinced the bull market was over. This mirrors the psychological pattern seen on June 22nd when fears of Middle East conflict triggered cascade selling. Back then, Bitcoin was trading around similar levels, retail sentiment hit maximum fear, and smart money quietly accumulated. 3 months later, Bitcoin was making new all-time highs above $124,000. The current drop represents just an 8.5% retreat from Bitcoin's recent peak. In traditional markets, this would barely register as a correction. But in crypto, where emotions run high and leverage amplifies everything, an 8% dip becomes a psychological crisis for unprepared investors. While retail investors panic sold, sophisticated players did the opposite. Santiment data reveals that wallets holding between 10 and 10,000 Bitcoin added 20,061 coins since mid-August. That's over $2 billion worth of Bitcoin accumulated, while everyone else was selling. These whale wallets have accumulated 225,320 Bitcoin since March, totaling approximately $25 billion at current prices. Their positioning has closely tracked future price direction for much of the past 5 years, making their accumulation patterns a reliable indicator of market direction. The behavior split between retail and institutional investors couldn't be more stark. Short-term retail traders, driven by emotion and social media sentiment, rush for the exits at the first sign of trouble. Meanwhile, long-term holders with deeper pockets and better information systems view these moments as opportunities to acquire more Bitcoin at discounted prices. When large wallets accumulate as retail loses confidence, this is historically the right combination for bullish momentum to inevitably return to crypto markets, Santiment analysts noted. This pattern has repeated throughout Bitcoin's history. Retail fear creates institutional opportunity. Understanding this sentiment dynamic reveals why contrarian investing works so well in crypto markets. Markets move in the opposite direction of the crowd's expectations, Santiment emphasized. When retail sentiment becomes extremely bearish, it often signals that selling pressure is nearly exhausted. The psychology is straightforward. When everyone who wanted to sell has already sold, there's nowhere to go but up. Retail traders, by definition, are followers rather than leaders. They buy high during euphoria and sell low during panic. This creates predictable opportunities for investors who understand crowd psychology. The current sentiment reading represents what contrarians call blood in the streets conditions. Warren Buffett's famous advice to be greedy when others are fearful applies perfectly to these moments. When social media is flooded with bearish predictions and selling recommendations, smart money quietly accumulates. Historical data supports this contrarian approach. Previous episodes of extreme retail fear in Bitcoin markets. March 2020, June 2022, November 2022. All marked significant bottoms that preceded major rallies. The pattern is so consistent that some institutional investors use retail sentiment as a primary timing indicator. Santiment noted that negative social sentiment becomes a good thing for dip buyers, especially when there is blood in the streets and fear is maximized. This isn't just market theory, it's documented historical fact. Bitcoin's drop to 112,600 and the accompanying retail panic may seem alarming to new investors. But for those who understand market psychology, it represents something different entirely. Opportunity. The combination of extreme retail fear, whale accumulation, and oversold technical conditions has historically preceded significant rallies. While no one can predict exactly when sentiment will shift, the ingredients for a recovery are assembling. Panic selling was a good sign of an upcoming dip bounce, Santiment concluded. This isn't wishful thinking, it's pattern recognition based on years of market data. When crowds panic, smart money profits. When fear reaches extremes, recoveries often follow. For investors considering their next move, the lesson is clear: the best opportunities often come disguised as disasters. While retail traders sell in panic, institutional investors accumulate with patience. While social media explodes with bearish predictions, whale wallets quietly fill with discounted Bitcoin. The market may be fearful today, but history suggests that ultra-bearish retail sentiment is often the prelude to ultra-bullish price action. Those brave enough to buy when others are selling have consistently been rewarded in Bitcoin's markets. The question isn't whether this pattern will repeat, it's whether you'll be ready when it does.